When it seems like the whole world is telling you a US interest rate cut this month is practically a sure thing, doesn't that feel like the perfect signal to start buying up US Treasuries? The thinking goes that if you buy in right before the rate cut, you could be set for life, with the US government essentially paying your way. Imagine buying a 30-year US Treasury bond today. It could pay you a steady 4.7% annually for the next 30 years. But if you hesitate, you might miss your chance. After a rate cut, not only could the price of that same bond be higher, but the interest rate you'd get would likely be much lower, maybe 3%, or even less than 2%. Historically, when the Federal Reserve cuts rates, they tend to push them down significantly, often below 2%. So, if you don't lock in a 4 to 5% rate now, you might miss out as we head back into another low interest rate environment. But is it really that simple? Hello everyone, welcome to Stewardship Finance Academy. We probably heard a similar pitch back in 2024, but with the opposite outcome. You might recall that when the Federal Reserve began cutting rates last year, the interest rate on 30-year Treasury bonds actually jumped from 4% to 5%. If you had bought Treasuries right before that, you would have seen the yield go up by 1%, which represents a significant drop in your bond's price, erasing about 25% of your expected profit. And that wasn't even the worst of it. If you had invested in the world's most popular Treasury bond ETF, its price plummeted by 15% after the rate cut was announced. As we all know, government bonds are considered one of the safest assets, which means people often invest large sums of money in them. So, if you had put $1 million into that Treasury bond ETF before the 2024 rate cut, you could have faced a paper loss of $150,000. This brings us to a critical point. Just because the Federal Reserve cuts its benchmark rate, it doesn't automatically mean that Treasury bond yields will follow. In fact, it's often the other way around. The red line on the chart represents the 2-year Treasury yield, and the blue line is the Federal Reserve's rate. You can see that the red line consistently moves before the blue line. In other words, the market leads the Federal Reserve. The interest rate on Treasuries only drops after investors start buying them up. And only then can the Federal Reserve follow by cutting the bank interest rate. So when people claim the Federal Reserve is cutting rates this year because of pressure from politicians like Donald Trump, it's a simplistic take. The Federal Reserve had already started cutting rates back in September of 2024. Why? The answer isn't found in inflation or unemployment numbers. For the last 30 years, the most reliable indicator has been the yield on the 2-year US Treasury bond. Let's look at how it has moved. In May 2024, the yield on this short-term Treasury was near its high, around 5%, the red line. But by September, it had plummeted to 3.5%, the green line. At that same time, the benchmark bank interest rate was still 5%. This created a huge gap. You could get 5% interest by leaving your money in a bank, but only 3.5% for lending it to the US government. Naturally, people kept their money in banks, making it difficult to sell new US Treasuries. Because of this pressure, the Federal Reserve acted quickly, cutting rates twice in September 2024, with the first cut being a swift 0.75%. Then they paused. Why? Because after those cuts, the short-term bond yield rebounded to around 4.38%, the yellow line. The Federal Reserve's new benchmark rate was 4.33%, almost identical. They couldn't cut further because if they did, the bank rate would be lower than the Treasury yield. And investors everywhere could borrow from banks to lend to the US government for easy profit, a practice known as arbitrage. Now, let's look at 30-year Treasuries, the long-term bonds. The purple arrow on this chart shows that the yield on long-term bonds fell before the Federal Reserve made its 2 rate cuts. But after the second cut, the long-term yield rebounded, and the Federal Reserve didn't dare cut again. To put it simply, the Federal Reserve cut rates in 2024 because investors were buying short-term Treasuries, driving their yields down. They stopped cutting because investors were not buying long-term Treasuries, keeping those yields high. You can see that from the beginning of 2025 until now. The 30-year bond yield has remained stubbornly high around that 5% orange resistance line. This brings us to the crucial question. What happens now? Is now the right time to invest in long-term US Treasuries? Or will we see a repeat of last year's tragedy, where prices fell right after we bought in? Today, I'm going to share my full strategy. If you don't want to miss the opportunities that come with these market shifts, you might consider subscribing to my channel for future updates. And if you're worried about forgetting these details, you can like this video to save it to your playlist for later. First, have you ever wondered what the real driver behind the Federal Reserve's interest rate policy is? This chart shows who is actually buying US Treasuries. Before 2008, the blue line, representing Japan, was rising the fastest. But after 2008, the red line, representing China, shot past Japan. After the 2008 financial crisis, China became the biggest buyer of US debt. This was part of an informal understanding. The US would buy goods made in China, and China would use those US dollars to buy US Treasury bonds. But that understanding unraveled in 2018 with the start of the US-China trade war. You'll notice the red line started to fall as China slowed its purchases. Then, after the 2020 pandemic and subsequent money printing by the US, China began selling off its holdings at a rapid pace. This sell-off put upward pressure on long-term US Treasury yields. With the biggest buyer stepping away, the US had to offer higher interest rates to attract other buyers. By 2022, the long-term Treasury yield had risen to 4.3%, while the Federal Reserve's benchmark rate was still near 0%. This created a massive arbitrage opportunity that would have drained US banks. To prevent this, the Federal Reserve began its aggressive rate hiking cycle in 2022, pushing its rate up to 5%. As China continued to sell, another country stepped in to buy: the United Kingdom. The yellow line on the chart shows the UK has now surpassed China to become the second largest foreign holder of US debt. And this presents a major problem. Imagine you are a British investor. Your own government's bonds are offering a 5.7% yield, while US Treasuries are offering 5%. Which would you choose? Any rational person would buy British bonds. Not only is the interest rate higher, but as a British investor holding pounds, you'd have to convert your money to US dollars to buy Treasuries. This year alone, the US dollar has depreciated about 10% against the British pound. So, a British investor who bought US Treasuries this year would have earned 5% in interest, but could have lost 10% on the currency exchange, resulting in a net loss of 5%. And yet, the UK has continued to buy, holding around $860 billion in US debt. What does this mean? One interpretation is that the UK has strategically tied its financial fate to the US. The unspoken agreement might be: the UK will help support US debt, but if the UK ever faces its own financial crisis, the US must provide support. If not, the UK could be forced to sell its US debt holdings, which could trigger a market collapse that hurts both nations. This has created a situation where the bond markets of the United States, Japan, and the United Kingdom are all interconnected. It's like the story of Cao's linked boats from the Three Kingdoms period in China. To help his northern soldiers, who were not skilled sailors, the General Cao tied his ships together to create a stable platform. The plan worked until his enemy, Zhuge Liang, realized that setting one boat on fire would cause the entire fleet to burn. We've already seen signs of this burning of the linked boats in 2025. In April, a US bond sell-off was followed by one in Japan. In May, Japanese bonds plummeted, and US bonds followed. In June, all three, US, Japanese, and British bonds, fell together. A crisis in any one of these countries could now trigger a terrifying global chain reaction. Now let's return to the 30-year bond chart. The 5% yield level has acted as a major resistance point. Every time the rate approaches 5%, buyers step in. Since September, this buying pressure has pushed the long-term yield down from 5% to its current level of around 4.7%. But now it has stalled, holding steady at what appears to be a new support level. This suggests that even as people buy, they are pausing at 4.7% to see what comes next. These chart patterns are useful because US Treasury rates are determined by the market. When more people buy, prices go up, and yields go down. The charts show us the collective actions of large investors, capitalists, and even governments. This is why successful investing isn't about predicting the future. It's about reacting to what is happening. Think of it as installing a smart fire alarm for your wealth. You don't need to know when or why a fire will start. You just need to trust that the alarm will sound when it detects smoke. Your job isn't to study the fire, it's to evacuate. When we see the exit signals and the major players are pulling their money out, we should follow. This fire alarm approach is a core part of the investment system we teach. In fact, we've documented the entire methodology in our free stock investment masterclass. If you're looking for a systematic way to build a portfolio and manage risk, I encourage you to check out the link in the description. So, let's get to the important part. How much can the Federal Reserve cut interest rates this time? The answer lies in the 2-year US Treasury yield. Last year, that yield fell from 5% down to 3.5%, the green line, which gave the Federal Reserve the room it needed to cut rates. But right after the cuts, the yield rebounded to the yellow line at 4.38%, forcing them to stop. Now, look at where we are. The short-term yield has fallen once again, right back down to that 3.5% green line. The US bank benchmark rate is still 4.33%. This gap means the Federal Reserve can cut rates again, potentially from 4.3% down toward 3.5%. However, this assumes the yield doesn't rebound like it did last time. So that 3.5% level has proven to be very strong support. So here's the risk. If the Federal Reserve announces a rate cut and the short-term yield immediately bounces back up from 3.5%, just like it did in 2024, they won't be able to cut rates much at all. They might repeat last year's scenario. 2 quick cuts, and then a hard stop. This means, if you buy treasuries now, you could be buying at a high price, only to see prices fall and yields rise after the rate cut. That's the first risk. The second, which affects nearly everyone outside of the US and Hong Kong, is the potential devaluation of the US dollar. The money you could lose on the exchange rate might be even greater than the interest you earn. You have to remember that countries don't manage debt like individuals do. If you can't repay your mortgage, the bank takes your house. But a country's goal isn't to repay debt, it's to borrow more to keep money circulating. Every dollar of debt repaid is a dollar taken out of the economy. For every dollar repaid, another dollar must be borrowed somewhere else. This is why government debt tends to only go up. And now some analysts, including the chief economist at Bank of America, have suggested the United States might eventually adopt a strategy similar to Japan's yield curve control, YCC. This would mean the Federal Reserve would commit to printing unlimited money to buy US Treasuries, forcing the interest rate down to a target level, say below 3% or even 0%. This would solve the debt crisis, but it could ignite a dollar crisis. Japan started its YCC policy in 2016, and the yen subsequently plummeted. If the United States follows a similar path, how much could the dollar fall? This is the fear that is making long-term US Treasuries so hard to sell right now. So here is my personal strategy. If I hold US dollars and I am not concerned about exchange rate risk, and I want to capitalize on a potential rate cut, I would focus on short-term US Treasuries with maturities of 1 to 2 years. Here's the logic. If the 2-year Treasury yield falls below the 3.5% support line, the next support level is around 2.5%, the purple line. Drop from 3.5% to 2.5% would deliver a significant profit on your bond's price. But if the yield rebounds from 3.5% after you buy, you can simply hold the bond to maturity and still collect your 3.5% interest over 1 or 2 years. This strategy allows you to be aggressive if the market moves in your favor, but defensive if it doesn't. Again, this is only a relatively lower risk option if you normally use US dollars or a pegged currency like the Hong Kong dollar. You won't need the money for at least 2 years. As for long-term US Treasury bonds, think very carefully. If the price drops after you buy, you could be stuck holding them for a long time, only to find that the US dollar has depreciated by the time you get your money back. And remember, after interest rate cuts, many other assets become attractive investments. So you don't have to limit yourself to treasuries. Time constraints mean I'll have to stop here. The logic in my videos is very interconnected, so if some details were unclear, I suggest watching my previous 2 or 3 videos. I will continue to share free information to help investors achieve financial freedom every week. If you don't want to miss it, I urge you to subscribe to my channel and turn on notifications. I sincerely wish everyone who liked this video the best on your journey to financial freedom. If you have any questions, please leave a message. If even 1 or 2 sentences I said today were helpful, I will be satisfied. Okay, see you in the next video.